Welcome to another episode of Unlocking the Upside. I'm your host, Jeff Robinson, and joining me today is James, our resident pragmatist and former buy-side analyst. Today, we're diving into something that's been keeping me up at night, the idea that beneath all the complexity of modern portfolio management lies a simple binary choice. James, I've been thinking about this since our last client meeting where everyone was getting lost in the weeds of asset allocation.
Yeah, what if we're making this whole thing more complicated than it needs to be?
You know what's fascinating? The entire world of investing, as with all its complexity and thousands of options, actually boils down to just two fundamental choices. You either own something or you lend money.
That's an intriguingly simple way to look at what seems like an overwhelmingly complex system. How did you arrive at that perspective?
Well, I've been studying how investment strategies have evolved since the 1960s, when everything was basically just that straightforward 60-40 split between stocks and bonds. Now we've got this maze of options, emerging markets, derivatives, cryptocurrency, ESG investments. But underneath it all, that basic binary choice still exists.
So you're saying whether I'm buying stocks, real estate, or even those complex derivatives, I'm really just choosing between being an owner or a lender.
Exactly right. And here's where it gets really interesting. These two approaches create completely different risk profiles. When you take an ownership position, you're essentially buying a claim on whatever value that enterprise or asset might create in the future. The potential upside is unlimited.
Though I imagine that unlimited upside comes with its own set of challenges.
Oh, you better believe it. Take the probability distributions we see in ownership assets. They show these wide dispersions with significant positive skew potential. In plain English, that means while you can't lose more than your initial investment, the upside could be astronomical. Just look at early investors in companies like Amazon or Apple.
And I'm guessing debt investments show a completely different pattern.
Exactly. With debt, you're looking at what we call negative skew. Your upside is contractually limited to getting your principal back plus interest, but there's this lurking possibility of default where things can go seriously wrong. It's like being a bank versus being an entrepreneur.
That's fascinating. How does this framework help us understand what's happening in today's market?
Well, right now we're seeing some remarkable opportunities in credit markets. High-yield bonds are offering returns in the 7 to 8% range, and private credit strategies can push even higher, sometimes 10 to 12%. These are historically attractive numbers, especially when you consider their predictability compared to equity returns.
And I suppose these opportunities emerged partly because of changes in banking regulations after the financial crisis.
You've hit on something crucial there. Traditional banks have pulled back from certain lending activities, creating this vacuum that alternative lenders and private credit funds have stepped in to fill. It's a structural shift that's really transformed the opportunity landscape.
So how does someone actually put this framework into practice when building a portfolio?
Well, instead of getting caught up in the latest investment trends or complex strategies, you start by asking yourself some fundamental questions. How much ownership risk am I comfortable with? What portion of my portfolio do I want in more predictable debt investments? It's about understanding your goals and risk tolerance through this binary lens.
That makes sense. It's like having a compass to navigate through all the noise in the market.
And here's what's really powerful about this approach. It works just as well for analyzing complex instruments. Take convertible bonds, for instance. They seem to blur the line between ownership and debt, but they're really just a combination of a straight bond and an equity option. You can break down almost any investment vehicle this way.
Even something as new as cryptocurrency?
Absolutely. Whether you're looking at crypto, NFTs, or whatever the next big innovation might be, you can still analyze it through this ownership versus lending framework. The technology might be new, but the fundamental economic relationships haven't changed.
Though I imagine implementing this approach still requires careful consideration of things like liquidity and market timing.
You're right on target. The framework helps us understand the nature of investments, but successful portfolio management still requires dynamic monitoring and adjustment. Markets evolve, opportunities shift, and risk factors change over time. The key is maintaining strategic consistency while having the flexibility to respond to changing conditions.
And what about the impact of technology on all this? We're seeing AI and algorithms everywhere in investing now.
That's one of the most fascinating aspects. Despite all the technological advancement, these tools haven't changed the fundamental binary choice. They've just given us better ways to analyze and implement it. Think of it like having a more powerful microscope. It helps you see things more clearly, but it doesn't change what you're looking at.
Looking ahead, do you see this framework becoming more or less relevant?
If anything, I think it becomes more valuable as markets get more complex. When you're faced with an overwhelming array of choices and constant innovation, having a clear framework to cut through the noise becomes essential. It's about seeing the forest for the trees.
That's quite a powerful perspective shift for thinking about investments.
And what's really interesting is how this applies to emerging trends like ESG investing. Whether you're focusing on environmental impact, social responsibility, or governance issues, you're still ultimately making choices about ownership versus lending, just with an additional layer of criteria.
So in a way, this framework helps simplify decision-making without oversimplifying the underlying complexity.
Precisely. It's like having a map that shows you the major highways without getting lost in every side street. The details still matter, but you always know where you are in relation to these two fundamental choices.
This really does change how you might look at portfolio construction.
And that's exactly why I find it so powerful. In a world where investment options keep multiplying and markets become increasingly interconnected, having this clear framework helps us stay focused on what truly matters. It's about making better informed decisions about capital allocation and risk management, regardless of how complex the market environment becomes. One last thing. Throughout my career analyzing markets, one thing has become increasingly clear. The best investment decisions often come from understanding fundamental principles rather than chasing complexity. That's exactly why I created Insight One. We've taken decades of institutional investment experience and distilled it into clear, actionable insights powered by cutting-edge technology. Whether you're grappling with asset allocation decisions or trying to understand market dynamics, Insight One combines deep market wisdom with innovative learning tools to help you make better investment choices. No jargon, no unnecessary complexity, just clear, practical investment knowledge adapted to your learning style. Visit theinvestmentanalyst.com or find us in your favorite app store. Let's build your investment expertise together.